Facebook and see.
And then I don't know when it's fine. Next said it's fine. He could stop his messages so that can hear.
Hello, check. Okay, testing 1, 2, and 3. Testing 1, 2, and 3. Ladies and gentlemen, welcome to our live streaming. We are just preparing, and we'll be going. Well, we're going live now, but we'll be introducing our keynote speaker in just a few more minutes. In a few more minutes, we will also have our mayor, Jan Kuhlman, from the city of Thornton, who's going to share with us important information about the city of Thornton and their Office of Economic Development and this great partnership that we have with the Alianza Business Assistance Center.
Ya tienen de nosotros para la estimación y está este para.
Huge auditorium, trying to get everyone's attention, and finally just sort of whisper into the microphone, let us know. And I got some questions. Thank you. Yes. Okay. Yeah.
Let me get the other. What's the other microphone? I'm gonna get that right there for him for a moment while I get the, because he's gonna go ahead and get started.
Okay, so do you have a presentation now? It's right there. So we can just hit share
You have it ready?
when he's ready. Is it in there?
I don't have it up there. I don't know how to get it.
You put it on
It's
the.
like that.
The audio? Mic? Is the mic on? Okay. I might share this with you if you don't mind. We're in a community center, so we're going to share our resources. All right, ladies and gentlemen, we're going to get this started in a few minutes. We have several people that are joining us through Zoom and also on social media and Facebook. I want to say just quickly, thank you all for attending today. This is very meaningful to us, the Hispanic Chamber of Commerce of Colorado, but also for many other chambers in different cities, in other counties. As you guys know, the Hispanic community continues to grow. And with that, also the need for some guidance, support, and resources. My name is Jesus Carrillo. I'm with the Hispanic Chamber of Commerce. I'm the Director of Membership. My job, as you guys know, as a nonprofit, it goes from recruiting, creating programs that can retain the existing membership, but also looking beyond our current present and seeing what's out there for our businesses. Our Hispanic community grows, but also our business community as well. Currently, we have over 100,000 Hispanic-owned businesses in the state of Colorado. Our membership is up to 2,500 members, and when we talk about our membership, it's a good number. But when we talk about the 100,000 Hispanic-owned businesses, then everything changes. Now we're no longer just serving those who are members of our chamber, but also those who are not members yet. But we know that whatever we do has a ripple effect that impacts them in a positive manner. What's happening today is pretty much a good example of that. More than a year ago, we sat down in this same room and we talked about the strategies. We talked about how we can partner together. And we talked also about how important it is to not just talk about it, but also put a little bit of action behind it. And today, this is proof. This is proof that this is a big step for our chamber, for the city of Thornton, but most important, for a small business community. As you guys know, we have great partners in the chamber. Some of those are small business, medium-sized, and large companies, large corporations, as well as municipalities, nonprofits, and the Federal Reserve, who is now today's our guest, and you guys will hear more from them as we have not only someone who knows economy, but also knows the Federal Reserve and knows what's to come. Before that, I would like to introduce our mayor of the city of Thornton, Mrs. Jennifer Coleman, who is here today. And for us, it's a great pride to have her here. And we feel honored to introduce them to the Hispanic Chamber of Commerce live on social media for those who are watching. And for those who are watching today, please feel free to share with those you know that might need it. Señoras, señores, bienvenidos. Ladies and gentlemen, welcome. Jen Coleman, the mic is yours. Can we use this?
Sorry, we have to do technology. All right. Well, thank you all so much for joining us today. Apologies for running a few minutes late. I unfortunately work in downtown Denver in my day job, and traffic was not very cooperative today. So hello and welcome to our Alliance Business Center, and thank you for coming to the Economic Update. I am Thornton Mayor Jan Coleman, and I appreciate the opportunity to speak with all of you today. So in a few moments, Mr. Nick Sly from the Kansas City Federal Reserve will be on economic items that are of interest to the overall business community. But first, I'd like to share some of the growth and successes we've seen in Thornton recently. So let's start with this beautiful space where we're gathered. In October of 2020, the City of Thornton opened the Alliance Business Assistance Center in response to the hardship being faced by businesses due to the global pandemic. And now, with more than a full year under its belt, the center is an alliance of private, public, and nonprofit resource providers joined under one roof to support and help local businesses start, grow, and thrive. Businesses who visit the center are offered free services in English and Spanish, as well as meeting rooms, co-working space, business consulting, workshops, and network opportunities. The Alliance Center's programs and services are provided by the City of Thornton Office of Economic Development and its essential business partners, Alianza and BTAC Business Advisory Commissions, the North Metro Small Business Development Center, SCORE Denver, Mile High United Way for Business, and today's event co-sponsor, the Colorado Hispanic Chamber of Commerce. In 2021, the center provided 621 counseling and technical assistance meetings and awarded $311,215 in business grants, and we look forward to serving many more in 2022. Let's move on to the retail sector. I'm happy to report that Thornton rebounded well following COVID, and most retail is returning to pre-pandemic performance. In addition, vacant retail spaces are starting to fill, and development projects put on hold during COVID are resuming activity. Some general trends that we're seeing are, unfortunately, employees are not returning as quickly as shoppers. So customer service and store hours have changed. Walk up, carry out, and drive-throughs are becoming a required location option for restaurants now. Slow to rebound are whole food grocers, movie theaters, and office supply stores. The e-commerce boom has created a need for local fulfillment centers. Thornton has enjoyed several noteworthy openings recently. Dry Creek Commons at 144th Avenue and Washington Street is now home to Starbucks, Advanced Heart and Vein Center, 7-Eleven, and more. The Denver Premium Outlets at 136th Avenue and Grant Street recently opened an In-N-Out Burger, a Raising Cane's, E&T Credit Union, Applejack Wine and Liquors, Satire Brewing Company's second location, and the Staybridge Suites with 4 stories and 111 hotel rooms. Other recent openings across the city are Yak and Yeti, Sephora, Anita Carniceria, Tout Le Jour Cafe, V Nails Spa, Hungry Howie's Pizza, H-Frame Custom Framing and Art, and finally, some of our exciting coming soon announcements. King Supers Marketplace will build a 120,000 square foot grocery store with an 18-pump fueling station at 136th Avenue and Quebec Street, and the anticipated opening is late 2022 or early 2023. The Grove Shopping Center at 144th Avenue and I-25 will see a mixed-use development with 30,000 square feet of retail and residential space. Eastlake Grain Elevator, our staff has received budget approval on this project and plans to move forward with development in 2022. So not only was 2021 strong for retail growth, but it was also a great year for primary job growth. Last year, Thornton added 6 new primary employers, which brought more than 750 jobs to our local economy. Even more impressive is that over 3,500 new primary jobs were created in Thornton in the last 3 years. Thornton welcomed these diverse primary employers in the last 18 months. Forge Nano, a technology company with 35 employees that design and manufactures nanotechnology coatings for various commercial uses. The Amazon Delivery Center with 400 employees that operate out of the center as drivers for Amazon's last mile delivery vans. Epicurean Butter, a manufacturer of flavored butters that brought 50 jobs to the area. And Meaty, a manufacturer of a mushroom-based meat substitute product. And they'll move their headquarters and manufacturing operations from Boulder to Thornton and will bring 200 jobs to their new facility. Thornton staff is very proud to have facilitated the delivery of over 3 million square feet of much-needed office and industrial speculative space to our area and is working diligently with multiple developers to bring more in the next couple of years. And some of the projects we are most looking forward to are redevelopment projects, which include facilitating the acquisition and redevelopment of the Thornton Shopping Center, completion of state-funded cleanup of the former AAA propane site at 891 North Washington Street, continued cleanup on the dry cleaning chemical source area at Plaza Las Americas, 88th Avenue and Washington Street, and starting a renewed effort to find quality commercial uses for the vacant land at Thornton Parkway and Grant Street, dubbed the Gateway District. And it's important to remember that one of the main driving factors for all of this development is the strong residential development that we're seeing. 2020 census information now puts Thornton's population at almost 144,000 people within 50,309 homes. And soon we will eclipse Lakewood as the 5th largest city in Colorado. And thank you again for joining us in person and online today. Our businesses are always a focus for the city and myself because we know how much you all do for our community. And I believe, Robin, did you want to introduce our guest? All right, well, I will turn it back over. Thank you again for joining us today. Very much appreciated, and I'm looking forward to this as well, although I may have to duck out. I do have a council meeting I have to run to. So, thank you.
Once again, thank you so much for the opportunity. Yes. Once again, thank you so much for sharing this with us and the opportunity to have this meeting here today. As you guys know, again, in business, we want to make sure that we have the proper funding, the right resources, the right guidance, but also very important is information. It's the intel, it's what's to come. And this is the reason why we have this meeting today, is to give something that is very tangible, that businesses need today more than ever before. As you guys know, we went through COVID, and this is not over yet. Our businesses need to be prepared, and they need to be informed. And for that, we have today an economist, and also a person that represents the Federal Reserve of the Bank of Kansas, Mr. Nick Sly. We want to give you a warm welcome to our chambers, social media, to our live streaming, but also here with the people present. If we can please come in.
Appreciate it. Thank you. Perfect. Well, welcome everyone here. Thank you for welcoming me. And I'm glad to see some folks joining online, as well as either through Facebook streaming, through social media streaming, or as through Zoom. Either way, we can get together and have a conversation and share a perspective. I'll take it. Although I will say it's been terrific to have a number of conversations here just as we're getting started, and to be here in person to share some perspectives. Very glad to hear the local perspective ahead of a national conversation. As the slides are starting to come up for this presentation, I want to give a sense of what I'm trying to hope to is convey as well as to hear. And I can.
Sorry, you got one more mic going on.
You betcha.
Make sure everybody can hear you.
It's perfect. All right. All right. You let me know if I need to move this closer up my lapel here. This is my car key. You guys don't need that here. I'm trying to get the presentation to move here. So this is I think it was a perfect segue is the conversation to have about local economic development. I'm going to provide what is closer to a more national look, really with the aim of trying to reconcile those different perspectives. And I think that's one of the most important goals that we have through the Federal Reserve Bank of Kansas City. So I actually am housed right on the 16th Street Mall down here in Denver, and value the opportunities to come and talk to business leaders, to talk to communities, to figure out what's different about the national narrative that's true from our region. What's different that's happening in your community that might be you might be hearing and seeing on the news and other parts, to make sure that those perspectives and those views are part of that monetary policy process. So I'm going to try to get out of my own way here as quick as I can, so we can have a conversation and a dialogue for you to tell me what might be different or what maybe I might have misrepresented, misunderstood. So I always have to start by saying the views are mine and don't represent those of the Federal Reserve Bank of Kansas City or the Federal Reserve System as a whole. So now that no one's willing to claim that, and I'm speaking for myself, let's talk a little bit about what we have to say here. So I may ask you, okay, I might work with you here just verbally to change slides. So some broader economic themes, and I think when it comes to putting together some presentations, this is actually the part that's changed the most, is what are the broader themes about the economic narrative, the dialogue that we've had over the past couple of years, even as we've been looking ahead. That narrative has been changing quite rapidly. And I think if we just went back to Omicron in January, is only a couple months ago, Delta before that, vaccines and some of the success that they had in getting people moving around again. I mean, the narrative has changed quite quickly. So what does it change into now is we're in a position where we've got strong economic growth. We've got strong labor market conditions, but we're all looking, I think, at the risk that comes to households, the risk that comes to businesses due to inflation. And even the narrative around that has, I think, continued to evolve. Is at first we saw that the prices that were going up tended to be for things that were very sensitive to the pandemic, meaning hotel prices weren't going up, some restaurant prices weren't going up, but cars and some durable goods, some retail goods, the prices of those things were actually increasing quite a bit. And so that's why the first look, I think, at some of the inflation numbers that we saw, it looked very much like a pandemic specific type of effect. And it wasn't quite broad-based. Now it's moved, I think, much more broadly, that it was into a position where you saw housing services start to go up and utilities start to go up, hotel prices and airline travel, those prices have started to recover. And so you're in a position where the inflation narrative has really evolved to, it's not hitting some part, I think, of each household. It's hitting really broadly many aspects of what they're spending. But even then, I think the narrative was really looking at the summer of seeing some of the economic forces start to normalize, some policy potentially starting to normalize, and that would have eased some of those pressures. But then we had renewed tensions and renewed pressures, this time in the form of geopolitical developments that's hitting energy prices and food prices pretty directly. And so I just say that as we've really have had a conversation that has evolved so rapidly over the last couple of years, interested to see what your take and what your experiences have been on those. Now, against that backdrop of strong economic growth and healthy labor market conditions, but high inflation and the dollar's not going as far, you're starting to see an evolution of the conversation from policymakers, specifically the Federal Reserve, the Open Market Committee, thinking about removing or changing the stance of monetary policy to try to quell some of those inflation pressures. So hopefully try to talk about that a bit more today. So go ahead and scroll on. I apologize for having you do this. I'm going to go pretty quickly through a couple of the first slides here just to hit some themes. But economic growth continues to be strong. A lot of that strength is coming from support from consumers. The biggest part of economic growth, you see household balance sheets looking to be pretty strong. Overall economic growth. We often used to use the phrase off the charts as a euphemism, but we did have growth that didn't fit on the charts here. But looking through some of those fluctuations, we're starting to see the growth outlook moderate, but moderate down to something that was closer in line with some longer term trends that you would have seen for the United States. So coming ahead, I did want to hint to say that growth does continue to look like it's being supported by consumption activity. So consumers seem willing to get out and about. More importantly, I think they seem willing to get out and about more broadly. It used to be if you could drive to a hotel, that those hotels would do fairly well, but if you were in a flying destination, you didn't see as quick of a recovery. If it was a goods that you tend to be more durable, things like computers and cars and other goods, those things were looking pretty strong, but services weren't looking as, spending on services wasn't looking as strong, particularly hotels and restaurants. Now the position looks a little bit different. Consumers seem to be willing to spend, seem to be getting out there, but they're willing to spend broadly. And in fact, are spending at levels that look like they're well above what we had prior to the pandemic. So it's not so much a question of recovery as much as it is about some normalization of activity. We're starting to look at that as we peer ahead. So coming ahead, where are consumers really getting some of this support for spending? I think one is the ability to move around safely, to gather like we are today, and with some degree of confidence. We're certainly thankful for that. But frankly, a big part of that is stronger labor market conditions. We had unemployment decline very rapidly. It recovered faster than in any economic downturn that we've ever had. So I think the unprecedented fiscal policy that was out there in the form of PPP and even some economic stimulus allowed households, I think, to get back, to retain their jobs and get back into economic activity pretty quickly. So I think that was one factor of this. And we are starting to see something of a pickup in overall labor force participation, that willingness of folks to be able to go out and look for a job. It's still somewhat subdued relative to where we were prior to the pandemic. Although I will note in Colorado, this is a national trend. In Colorado, actually, the size of the labor force is bigger than it was prior to the pandemic. It's bigger part of it because of in-migration, but we also saw pretty healthy recovery in overall participation in the workforce. One, I think, section to really call out that has been more difficult has been child and family care sector. That is a part of the sector, either the labor force or as an industry itself, that didn't fully recover. And that's particularly important because not having childcare keeps other folks out of the labor force. Providing for elderly parents or elderly members of the family staying with you, taking care of them, whereas that might have been something that took place in assistant care facilities and other private sector solutions. That burden is now falling back on the family in a way that can keep labor force participation down. So we do see that as being something that's holding back the ability of workers to go back a little bit, but certainly a stronger than average recovery here in Colorado, nonetheless, still posing some challenges for businesses. So moving ahead, I just want to talk about job gains. We're getting monthly ticks, monthly readings of job gains that are well above what we would think as long run neutral, long run natural, meaning for all the folks that tend to be retiring, you have to replace them with new workers coming in, new jobs being available for those workers coming in. We're certainly getting more jobs than that. But I think what's most important about the last several months, besides the fact that it was pretty healthy and robust coming out of Delta wave and even through Omicron, was the fact that the job gains we're seeing now aren't tied to recovery from the pandemic. So it used to be leisure and hospitality, hotels and restaurants were adding the overall bulk, and it was really, that was getting back out of the recovery. Now it's broad-based. You're seeing job gains in transportation, certainly a lot of demand there, job gains in manufacturing, certainly a lot of demand there, job gains in other service sectors, albeit remaining fairly strong. And so I look at this and see, unemployment low, job gains remaining high, and even onto the next slide, if for the gains that they can, the jobs that they can actually add each month, we're seeing even more job openings be available. So on the next slide, it's the number of jobs nationally is much higher than the number of people who actually would be looking for work, or those that are unemployed. And by that, I mean, for every one person who's unemployed looking for a job, you got about 1.7 jobs available. This is the time where you often, I don't want to, being that I'm presenting some figures, ever say that you don't want to put too much stock in them. But most of the time that I talk to some businesses, they say they've got, 10, 15 jobs opening. What they really mean is they have 50 or 60 jobs available. And so if anything, this might understate how tight the labor market is in the current economic condition. So that, I think, is healthy is a boon for growth. It's healthy for consumers. It suggests that getting to work and maintaining an income could be strong. But there are some consequences of this surge in demand for workers, broad growth and for workers, and that's inflation pressures that start to come up in the form of either wage growth and sometimes other cost pressures that they can't pass on. So I'm going to take as much tension out of the room now, noting that we want to talk about the tensions that are sitting there on our price pressures. So for the last half of this presentation. So if I can move ahead to the next slide here. One thing that we have seen that those strong labor markets, like I said, have been supporting wage gains. An important factor of that is that those wage gains have started to be more broad-based, where you've seen wage gains for high, middle, and low-skill workers. So it's been pretty broad-based. In fact, it's been outpacing the average among low-skill workers. You've seen wage growth start to pick up for Black and Hispanic workers faster than it had been prior to the pandemic and the equalization. You're seeing some normalization there. And so it's been broad-based wage gains. But of course, going ahead to the next slide, that does mean some broad-based cost pressures for businesses. So let me just set the stage of where we are. And you could have taken this slide back even a lot further from 2000, which is to say, despite some of that economic strength, inflation is at a point where it's running at well above what we consider as the target of 2%, well above what we had really seen in recent history. And I would even go as far as to say the narrative is very different. For the last 10 years or so, during what was the longest expansion in economic history, it was an expansion that didn't have inflation. The conversation was, could you get inflation back up to 2%? Could you get businesses in a position where the expectations were high enough to support the 2% objective? Now the conversation is different. Of course, it's how do we ease the pressures for businesses? How does the committee think about adjusting monetary policy to restore price stability? And I highlight this because this is the key objective that was given from Congress to the Federal Reserve, is to promote maximum sustainable employment and price stability. And so the question is what are the actions that the Federal Reserve needs to take, or what are the experiences that you're feeling that inform that decision about how to restore some of that price stability? And moving to the next slide here, I think there's a couple of ways to think about the challenges that come from the high inflation. First, even though labor markets are strong, wage growth is there, job gains are there, they're broad-based, they're across different sectors, they're in rural communities a little bit more than they had been historically, they're in urban and suburban communities. You're seeing strong labor markets. You're still seeing consumers actually look at rising inflation. And if you notice that the decline in the level of overall consumer sentiment is actually lower because following the strong inflation reads than it was during the pandemic. So I think that we're hearing from consumers that this is a real challenge for them, or at least making them wary or cautious about what it is they want to spend. So it's certainly weighing on the minds of consumers. Going to the next slide here, it's absolutely hitting businesses as well. So a way to think about the two lines that are up here. One is raw materials, the core materials, the first things that businesses have to buy for every good and service that's produced. Those are then fabricated, processed, added, and moved all the way up to processed or finished goods that are sold to consumers. And what we're seeing is something we don't often see in history, is that the raw materials fluctuations are much, much bigger than the finished goods, meaning cost pressures for businesses are rising much faster than their ability to pass them on to consumers. We run surveys where we actually ask and poll some of these businesses, how much of this can you actually pass on? And really the majority of businesses are telling us we can only pass on 20% or so of these, which is just not a sustainable condition to be in. And so absolutely a challenge for businesses as much it is as a caution for homeowners. So heading into it, what parts of this might we see that is somewhat optimistic about the inflation outlook? Well, in particular, this is inflation pressures that are broad-based, but are certainly showing up in some parts of households' spending more so than in others. And in particular, durable goods. So this is cars, computers, phones, the things that last a while. Those are also things that you tend to buy with credit and that you tend to buy by borrowing money. And so, meaning another way to say that is, these are the types of goods where the purchases or the demand for them is much more responsive to monetary policy, meaning that we're in a position where the policy tool that the Federal Reserve has available to itself, while often criticized or characterized as being quite blunt, in this sense is actually hitting directly some of the parts of the consumption basket that are the most pernicious for overall inflation. So in that sense, I think there's a little bit of optimism that you would expect that monetary policy can cool some of those pressures. The natural adjustments of consumers coming out of the pandemic can cool some of those inflation pressures. But like any good economist, I'm going to use my other hand here. On one hand, there's some pressure that could lightly moderate over the course of summer. But on the other hand, there are some renewed factors that are likely to keep inflation pressure stoked for the coming year. Most recently is been the uptick in shipping costs, the supply chain disruptions, and then the further disruptions that have come out of that because of the geopolitical developments. So while I think there are things to look at that suggest that there are actions to be taken by the Open Market Committee to start to ease some of those demand pressures, well, there's reasons to think consumers are going to adjust their spending in a way that would look like it might moderate some inflation. You know, the shipping cost is something that tends to take a little while to work through, and I think we're going to still be dealing with that for a little while. And then even on the next slide was the uptick that we saw in energy prices. So besides the human toll that the war in Eastern Europe is reaping, you are seeing global markets transmit the effects of that, the economic effects of that, home very, very quickly in the form of higher gasoline prices, in the form of higher natural gas prices. So heating your home in some of these cooler weeks that we've had is going to be a bit more expensive. And then of course in the summer, electricity production can be a little bit more expensive. So these are things that I like to highlight because very few of us buy a lot of natural gas directly, but we sure do it in the way that we heat and cool our homes. And we certainly buy a lot of gasoline as we start moving around and trying to enjoy the summer. So those prices, I think, will stick around for a little bit more, just given recent geopolitical developments. Now, I've made mention recently, several times, about policy actions that the Federal Reserve, so the Open Market Committee, can take to actually quell or pull back some of that demand. And at their meeting last week, there was what was called the Summary of Economic Projections, where each of the participants on that committee, would make a projection for what they believe, if the economy unfolds as expected, the appropriate rate of policy would be. Now, what is not shown here is what that projection was just a few months ago. So in December, it was not calling for as high of interest rates at the end of this year or next year. But you fast forward just a couple of months, and each dot, which is a participant on the FOMC, the Federal Open Market Committee, most of those dots shifted up for 2022, meaning that more and more of them thought that the appropriate stance of monetary policy would have much higher interest rates by the end of this year. Another notable development that came out of that is several of those dots for 2023 and 2024 were above what they thought the long-run natural rate of interest was, meaning not only had expectations shifted that it would be appropriate to start to remove some of that historic accommodation that was out there, move it away more rapidly this year. In fact, it could be appropriate to tighten next year. I would say that this is one of the most important conversations that I would want to hear from you is, what are your expectations over the coming year? Because an awful lot of conversation, an awful lot of dialogue, and I think, importantly for me is, my boss is one of those dots and wants to know what's happening in Colorado, what's happening in your communities, to inform what her thinking is as she sits at this table. And so lots of discussion on what the appropriate rate, the pace of removing some of this policy accommodation, how much can be tolerated, how appropriate it is, how difficult are the strains that are posed by inflation relative to how your employment outlooks for those of you running businesses where you're hiring workers. I think calibrating that policy appropriately really relies on a lot of the conversations that we have here. But certainly, I think a significant move in what the outlook for the appropriate path of interest is. So I hope that sets the stage a little bit for what it is that I'm seeing as I look ahead, but also appropriately hedges so that I can ask questions about what it is that you're all seeing ahead. So just to sum up here, I think in the last part, where are we? Strong economic conditions, both from labor markets and from overall economic growth, strong consumer activity. But the reality is that inflation pressures have become more broad-based. There's many factors of that inflation outlook that are starting to look to be more persistent. And so the conversation is, how can you appropriately remove some of the accommodation, the dollars that are out there fueling some of this economic growth? How can you appropriately pull that back to ease the inflation pressures without itself being so much more disruptive? And the way we tend to characterize that is, what's the appropriate pace of removing some of the policy accommodation that's sitting out there? I think that concludes my formal remarks. I'm really looking forward to having an open dialogue with you all, but thank you in the room and online for listening. Yeah. And I'd be glad to take any questions, open-ended here. Yes, sir. Okay, and I can also repeat the questions too for the folks that are online, if that's helpful. All right.
I'm on the hot seat.
That's fine.
I was looking at historical inflationary cycles, and it seemed like, looking back 20, 30 years, it was a couple of years before things moderated to the level significantly.
Yeah.
Do you think that this is a 2-year inflationary kind of thing? Is that realistic, or is it shorter or longer, or what are your thoughts on that?
Yeah, I think that's a good way to frame the question, because the pithy but often unsatisfying answer is that one of the best ways to predict inflation is to use inflation, what happened in the past. And so, meaning it really does depend on what's happened recently. That said, many of the inflation cycles that we've tended to see, depending on how far back you look, it was services. It was spending on households. So your rent, your what you spend on your mortgage, what you spend on heating and cooling, the utilities for your house, other services that were really the main driver of overall inflation. And so you look at that as what was keeping inflation somewhere near 2%. It was really the ebbs and flows around the price of services. That has not been the case right now, right? It's typically been where a lot of the push in inflation has been for goods. So you have to be careful applying the experience that we saw in the past to what we're seeing today. So it's likely that you could have gotten, I think, prices to moderate much faster, given that it was fueled by goods previously. That said, the number of developments that we had is that labor markets recovered very, very quickly. Household balance sheets recovered very quickly. And then we had geopolitical tensions pick up that actually hit raw materials, commodities, and goods. Some of the supply chain disruptions are primarily affecting goods. And so I think that's the challenge is, typically you would have seen goods pressure start to correct a little bit faster, but the ongoing pressure from supply chain constraints and then the renewed disruptions due to geopolitical tensions might keep them up a little bit. So that's a lot of words maybe the shorter answer is, I don't know. I think that's what you want to look at. But at least I can be honest about how it is I'm thinking about it. Yeah. Yeah. No.
Any other questions?
Where do you see the rates be by the end of the year?
That's right. Well, so the questions about the rate environment, I'll go back a slide if I could, one slide to the dot plot. So the summary of economic projections, the dot plot. So I won't make my statement about rates. What I would rather point to is the people who actually have that vote is here's what their expectations are. And that conversation has evolved fairly quickly, is that for 2022, if you were to hit what we say is the median projection, that would have implied a 25 basis point move at every meeting for the rest of this year, as I think would have been consistent with that. However, you did see that one of the participants dissented from the last action, suggesting they should have a 50 basis point move. There's been some other participants on the committee who suggested that faster moves could be appropriate. And so these are never preset plans, partly because you want to look and see how markets are developing. But the best answer I can give to your question is here's what the folks that are voting are projecting is getting up to near 2% by the end of this year, overshooting the natural rate the following year, actually tightening policy, and then coming back down to the longer run natural rate after that. So that's the best I could give you for that. Yeah.
Now, how they consider that, because you look at the real estate market locally here, where the average first-time buyer is looking at spending $350,000, and you look at a 3-4% interest rate, it kind of takes people out of the game on that part. Or so, yeah, it benefits some parts of the country, but might hurts us economically, because now all of a sudden people can afford their own homes.
Right. I think that was one of the bigger challenges that you're talking about is around rent. And I would point out why it's so important to have that regional perspective that was there. That during 2021, if you look at 2021 compared to the previous year, actually rent inflation slowed down. Housing price inflation slowed down. And I don't think anybody in Colorado would have pointed to that, right? There was some coastal differences relative to where we were. And so I think that was the challenge of having a national number, because you did see some different regional implications for this. So I also think that the way that we were using our homes started to look a lot differently. We're certainly using them a lot more for the folks that are joining online, for example. So there were certainly different types of demand pressures in there for housing. The challenge is going to be how balanced can you have the adjustments? Is wages moving as quickly as housing price growth? Certainly not over the last year. But are wages keeping up with that general consumption basket? In that sense, it becomes less of an issue for the households and their spending. I'm not saying we're there, but I think about it both as that broader set of goods that folks tend to be buying, as well as trying to highlight some of the regional differences there.
Yeah, because if you want to hear what's happening on the street, people are freaking out on the 4% interest rate, even though it's low.
Yeah.
According to where we've been in the past, I remember the first house we bought was like 7.25, and we thought that was such a great rate.
Yep.
And for the last few years, people don't even understand that that's possible. And yeah, of course, back when I bought my first house too, it was $125,000.
Yep.
Next to where we are now. So I started to see now, even from the people in the lending business, they're starting to see the business slow down a lot, because now they're talking to people, and this is normal, and it might go higher. And so that's why my question was, they continue to see the rates go up. It's going to continue the rates to get to 5.5, 6%.
Yeah.
And so, and I know, like you said, it's kind of weird, because you got cost to cost is so different.
Right.
Pricing everything. That's why I was curious who makes the decision basically that this is what's best for the for the nation, when that's going to affect other states more directly than actually overall.
That's right. No, maybe I'll take that. I want to come back to the conversation about interest rates and buying power for homes. But how these decisions are made. So there's the 12 Federal Reserve banks across the country, and then the Board of Governors that sits in Washington. And each of those banks has a responsibility to represent their own district. So that's why I said the Federal Reserve Bank of Kansas City, Colorado's part of that district. And so we're informing that bank president on conditions that are happening here locally. And when she goes to the table, President Esther George goes to that table, part of that briefing is, here's what's happening in our region. Now, that said, there is a singular tool of monetary policy. It is a national tool, but it needs to be informed by that regional perspective. And so that's the way that actually works. Coming to your point about purchasing power for households, taking some of that out and with higher rates is really one of the main ways that monetary policy transmits to price growth, right? Is taking away, I think, some of the ability to bid up housing prices is how you quell some of the inflation pressures there. But it's also, we need to have this conversation every couple of weeks, every couple of months right now as you come into a tightening cycle, because it's, to your point, when does it become more difficult? And when does it become to the point that it's more burdensome and it's actually cooling housing prices too much? That's the calibration that I think that they're faced with, is how do you relieve some of this economic pressure coming from accommodative policy without being disruptive? And it's going to be a point to calibrate. Why I was so keen to emphasize these are projections, not plans, as we always want to rapidly respond to what we're hearing from you all.
And it does take into consideration what the fiscal policy is going to be, which is that's the one that's kind of like you're more, because then you guys get to play, okay, how do we make this fit now?
Yeah. And regardless of what the policies that Congress or state and local governments put out, is we have that responsibility. By we, I mean the committee having the responsibility for to respond appropriately. Yeah. Yeah. No, I think this is the discussion, because policy always has consequences both ways.
I would not want to be part of your guys' job. How your fiscal going.
I'll say
Go this way.
they say that, but you are an important part of it as that input. I really do value it. So I know.
What do you see for the agricultural community next year? So somebody, there's winners and losers with every event. Seems like that might be a winner type industry.
Yep, and I'll repeat it just because for the mic. So the question was about pressures in the agricultural sector. Is it a boon, or and I'm paraphrasing the question. Is it really a boon for local farmers, or is it a cost, or some combination of both? We're certainly seeing, when I talk about renewed geopolitical developments, let's put a finer name on that. It's commodity prices in the form of energy. I didn't put up agriculture or even some metals that are exposed to the disruptions we're seeing in Eastern Europe and with the sanctions imposed on Russia. So yes, we are seeing agricultural conditions shift dramatically. Wheat, which is the larger input to our calorie intake, and the largest input to our calorie intake, prices are up. They were up rapidly and up quite high. And so in that sense, corn prices are also up. Soybeans are still, prices are still up. So you're seeing broader movement up. It's not all a boon for farmers, because the other one that I pointed out was natural gas prices. And what you may not have thought of is potash that comes out of Russia and Eastern, in some parts of Eastern Europe, which taken together makes it's a key input into fertilizer. And so, yes, you're starting to see the selling prices go up, but you're also seeing those fertilizer prices and the input prices starting to go up as well. Combines and manufacturing that have been hit by supply chain disruptions for so long and are still waiting on chips, or are still waiting on parts, still waiting on steel. Those combines are difficult to come by. So I think you are seeing the ag sector get pinched on both margins. Generally, you're seeing prices go up. Land prices for farm, general ag conditions, whether it's irrigated or not, are also up. But I think you've seen a real disruption into that ag sector for sure. But I would be careful to characterize it as prices went up and everything, it's all benefits accruing to ranchers and to farmers. That doesn't quite seem to be the case. Yeah. Yes, sir.
So,
Right.
I mean, I barely got like a C on my macroeconomics class. It is my major, so hopefully I'll be comprehensible here. Would you say that this is demand pulled inflation?
It's a great question. I think it's important. So I'm speaking for myself. Is there demand? I'm going to maybe rephrase it just a little bit. Is there demand pulled inflation? Yes, absolutely. I think consumption is above trend. It's spending more than typical, so that's part of it. Labor markets are very tight. That's a demand pull, I think, as well. However, not an and or, I would say there's also some pretty significant supply chain disruptions. And so there's some parts of it. So trucking, ocean shipping, parts availability are all creating cost pressures. So I would say it's both. Okay, you got to follow up here.
So yeah, we have demand, right? So
No.
we're talking about consumers who demanded, obviously the price increases.
Yeah.
Those decisions are made basically by those entities
Mhm.
in order to maintain the quota. Or I don't know exactly how they work, but because it's demand pulled, it's basically saying that we're wanting these commodities that are being restrained by supply chains
Mhm.
or other services. I don't know. I'm looking at it in a very narrow perspective,
Yeah.
just with products, for example.
Yeah.
Would you say that's like the prime reason? Because if you go on like Facebook and you go into the comments section and you get obsessed with it like I do, you see people saying it's stimulus checks, it's all sorts of other political factors, and quite frankly, like most of us don't even know what we're talking about. We're just trying to pull point fingers.
That's right.
So it's kind of good to just have something we can say. Or,
Yeah.
you know?
I think it's, and I think there's a lot of, this is the challenge. I think there's a lot of perspectives that are out there, and I want to be careful because I think all of them are really valid. The experience that's probably one of the most important is the one that folks are having for themselves when they go to the grocery store, when they're having to pay for rent. That's the experience I think, really matters for folks. And so we do want to hear that. The challenge of what can you do to ease some of those pressures, really, that's where I think the issue of what's the appropriate policy response and how do you manage that? That I think is best informed by how much of this is supply and how much of this might be demand. I really do firmly believe that it's both, and I might answer a little bit differently. It's less about, is it more of one or the other? Which one's going to last longer? So demand is one of those things that we had already started to see moderate as the growth chart was starting to come down. We'd already started to see some of that moderate. Demand had started to come down for some goods in ways that we I think it would have anticipated, that I was anticipating. Monetary policy primarily works by raising interest rates, changes the incentive for folks to actually spend those dollars. So that's another thing pulling the demand off the table. You see that happening a little bit more in the near term. Okay. Supply chains, though. Supply chains are things that I think are really acting on the longer term. And I think that's where it creates the challenges is can you bring them back into alignment at the same time is another challenge for sure. So I tend not to think of it as one more than the other. I would never put a number on there because I think there's not a way to credibly disentangle one from the other. But I do see some pretty stark differences in what I expect to be happening on the demand side over the next 6 months versus what I expect to see on the supply side over the next 6 months or after. I'll just say we have really been rethinking global supply chains as a country, as a global economy for well before the pandemic. And you're seeing some shifts there that haven't settled on a particular strategy. Just in time was very lean, it was very fast, and it was inefficient. It was low cost, but we did see that it is fragile and it caused some challenges. So what we're going to return back to, I think, is a question. I think the way that we do shipping and inventorying with a lot of last mile drive, we talked about even in Thornton taking advantage of this, of having distribution centers here, which is a lot more shipping that takes place with last mile delivery as opposed to going to big box stores where it's the consumer that's driving around a lot. So there's a lot to be settled on that supply side that I think will take a little while for us to work it out. So I really don't, I know it seems like I'm just not answering your question, but it's just not how I think about it. It's more one or the other. I would love to know, but it takes a crystal ball, not any sort of analysis that's going to answer it. But what I do feel confident in saying is that some of the supply chain things are taking longer to work out than we would hope. And I still see them taking some more time even into the latter part of this year and into next. So, yeah. 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 I have to think about this. It's either very communal or very aggressive where you throw a microphone at someone. It's terrific. So
It just helps me.
there you go. That's right.
So question for you. We
Yeah.
have a transportation company.
Okay.
We've seen new truck prices go from 140,000 up to 240,000.
Okay.
Swing of 100,000 in 18 months.
All right.
We've seen fuel double. Parts up 100%. Tires up 25%. Parts that we cannot get are on backward.
Yep.
Make these trucks go. So it's making the demand grow and grow and grow. So we're at the point where we need to purchase new equipment. Is this something you would purchase in a time like this? Do you see a crash coming? Because as soon as this all gets back, I mean, so now you own 240 on a truck that's worth 140. How long is that?
Yeah, I think I'll just say it this way. I think it is tough economic conditions when business owners are having to think about, do you buy something worried about buying it on spec?
Well, that's the thing, you
Yeah.
can't grow, but the other thing is everything's up so high that you can't pass it on to your customers either. You can't take it away from your
That's right.
employees.
So can I ask, if you say trucking, so you're talking rig long haul?
So we're here in town, we have flatbeds with forklifts, so we haul to commercial sites, haul to oil and gas fields.
Yep.
Yeah, just whatever we can put on a flatbed.
Okay. Yeah, I won't get into. I want to make guidance or advice. I think you're closer to that. But I'll tell you how I tend to think about these things is the level of uncertainty that we're seeing. is uncertainty itself is a barrier to economic growth, and it's a barrier to demand because it causes you to sort of put off some of these. And so I think one of the more important things is going to be as you start to get more and more clarity about how economic conditions are developing and how the policy environment is starting to develop. So I think the question around uncertainty is very much an apt one, and it forces us to think about, could we provide clarity while also being as transparent as possible? And unfortunately, those aren't always the same thing. When it comes to the supply chain disruptions and the availability, I was talking to some truckers about on the long haul side of buying tires that they never would have bought before. They weren't even the type of tire they would have for fear of not being able to get some next year, knowing when they're going to depreciate. And that's putting an onus on these small businesses or even small sector businesses to now have to manage an inventory of goods. It's adding a whole part of their business that they didn't necessarily have before. And that's not the business they wanted to be in. Otherwise, they wouldn't have been in it before. So I hear the challenge very, very much. And the way that I really try to digest it is, are there any indications that I think over the next couple of months that uncertainty started to decline? And I'm watching for that. Do we see a resolution to geopolitical developments that affect energy prices? Do we see decongestion in some of the supply disruptions that we're starting to see on ports and roads? Those to me are indications that, okay, there's a little bit less certainty for businesses to manage and they'll be more confident making those decisions. But right now, I think we're in a position where the uncertainty itself is a barrier. It's a challenging one. Yeah.
Do you see it leveling out, or do you think it's going to keep going up?
Well, I think that I mean, more broadly, I do see growth moderating, which I think is what you mean by leveling out. There is, yes, I do think over the long run, you're going to see some of this start to growth to moderate, come back closer in line to trend. I mean,
You guys would be on top of it maybe a little bit sooner than you would in the past, just because of the position we're in now, and maybe catch it before.
Yeah, So would we be on it? The question me, would we be on it a little bit faster? By we, I mean the committee. Are they reacting to it a little bit faster? That one, I guess I can point to is that same dot plot. If you looked at how we actually raised interest rates coming out of the global financial crisis, how quickly did rates actually move up? Once in 2015, once again in 2016, and then it was starting of a little bit of a march. And then we didn't talk much about it, but one of the other things the Federal Reserve did was bought a lot of assets to put additional dollars out there and pull some of those assets off. We call it the balance sheet. Already, I think the chairman talking about that expected to be much faster this time around. So when I look at this is so much faster than what we had last time around, really responding to those inflation pressures. The expectations for the balance sheet adjustment, the other policies of the Federal Reserve enacted, expected those to come off much faster. So yes, I do see a much faster policy response. The challenge is going to be, how do you have it level out without having it pushed down? And that's where they're after. Yeah. But I mean, you talk about it from the tires to the transmission, to the steel, to the brake pads. I mean, every part of this, the truck's hard to get. So I think it's a challenge. I know. And I'll even take critiques. So. All right. Yeah, are there questions from online? I wasn't sure if we had a.
Do we have online questions or comments?
No? All right. Well,
Okay.
Thank you all for the chance to be able to come and meet with you and have this conversation with you. I very much appreciate it. So,
No, thank you so much. I appreciate it.
Jesus.
Thank you. Once again, we want to thank the City of Thornton for this great effort. We want to thank our host, Alianza Business Assistance Center, for giving us this opportunity again to gather together, provide and information to our whole business community. Special thanks to Nick Sly, Assistant Vice President, Economist, and Denver Branch Executive. What a title, isn't it? We also want to thank you all who are watching too. Thank you for sharing. Thank you for providing us some of the questions, but also for helping us grow. The Colorado Hispanic Chamber of Commerce wants to thank you on behalf of the Board of Directors, our staff, our President and CEO, Mike Ferrufino, and everyone who makes this possible. We want to thank you and thank you for watching. Muchas gracias. Thank you. And till next time.